Hey, everybody, I'm Leah Collich with RealWealth, and I'm joined today by one of our preferred lenders, Caeli Ridge at Ridge Lending Group. I've asked her to come on today because all of us investors who work here at RealWealth are putting our heads together about what makes deals work today. And we're all kind of in agreement that it's probably in your best interest for us to be advising you to use adjustable rate mortgages. But these suggestions are often met with a little bit of pushback. And we think it's just people don't understand this loan product. So I asked Caeli to come on today and just kind of have a conversation with me about what is an adjustable rate mortgage today, how does it work, and what are the real risks. So, hey, Caeli, what do you think?
Hey, Leah. Hi, Leah. Thanks for having me. Yeah, I'm having the same conversations that you guys are having, and I think that what's missing is the education of it. And for those of you that end up hearing this, I want to start by saying that this is empirical data. Okay, this is not opinion-based stuff. Well, I may throw in some of my own opinions as well, but I'll make sure to preface that. But I do think that largely investors are uninformed about the 30-year fixed and the adjustable rate mortgages. So maybe we'll start with what is an adjustable, how does it work? An ARM, adjustable rate mortgage, is a component of two different numbers. You have an index and a margin. The index is variable, and there's dozens of indices out there. The Fed fund is an indice. Prime rate is an indice. So there's lots and lots of index out there to choose from. And then you've got the margin. The margin is fixed. That number for however long you keep that loan can never, ever change. The two of those numbers added together is a fully indexed interest rate. And that's how the initial rate for whatever term you've chosen, and an ARM can be a 6-month ARM, a 1-year ARM, a 3-year, 5-year, 7-year, 10-year, right? There's a whole variety of durations where the interest rate is fixed for that period of time before the rate can start adjusting based on predetermined rate caps. Now, this gets a little bit technical, so I'm going to just abbreviate a little bit and we'll touch on whatever you think would be helpful. But let's say, for example, you start with an interest rate of 6.5% on an adjustable rate 5-year mortgage. At the end of 5 years, the way in which that rate will adjust is dependent upon what the rate caps were when you originated the loan. So the rate caps, I mean, it can vary a little bit, but let's just take a standard 225. There's 3 numbers there, a 2, a 2, and a 5. The first number represents how much the interest rate could adjust or increase in the very first rate adjustment. The second rate indicates how much the rate can increase with each subsequent rate adjustment if you let it just adjust, keep adjusting. And then the last number, 5, is the life cap. So let's just kind of run through that math really quickly. So again, if you started at 6.5%, and at the end of 5 years, the index was up a full 2 percentage points to where that addition of the index and the margin would take your 6.5 to 8.5. That is the max it could go. If the index was up 3% over where you started, it couldn't go to 9.5. It could only go to that 8.5. That would be the cap in the first rate adjustment. The second 2 is each subsequent rate adjustment. Now, it's going to be important to understand what your loan product is. Is it a 5-1 ARM? That 5-year fixed with the 1 after it means that it can adjust 1 time per year. If the loan was a 5-6 ARM, that means that it's fixed for 5 years, but then the rate can adjust every 6 months after the first 5 years. So make sure that, if you get into an ARM, you understand the differences in how many times the rate can adjust after the fixed period, how many times in the 12-month period afterwards.
Caeli, do you know when you start one of these loans, do you know what the life cap is before you close on the loan?
Absolutely.
Okay, so you have a ceiling, the worst case scenario going into it.
Absolutely. So each rate, so 2% is the first max, 2% is the next subsequent match, cannot exceed in any given time more than additional 2%, but then the life cap is 5. So if we started at 6.5, we know that 11.5 is the absolute maximum that rate could ever go for 30 years, right? You could keep this loan for 30 years. This is not a balloon feature loan that says that the note is due at the end of 5 years or whatever it is. Right. It can just simply adjust, right? So that's the components or the mechanics of an adjustable rate mortgage. Why don't I jump into, Leah, with your permission, just some of the statistical background in ARMs. And as I'm doing that, I want to actually take a step back in time and start from pre-08-09, okay, before the housing and lending debacle. Adjustable rate mortgages were mainstream. In fact, I would say 98, 99% of the mortgages that we would close for investors were on adjustable rate mortgages, because then we were not on what's called an inverted yield. So 2008, 2009, that meltdown created a scenario where adjustable rate mortgages, it was an inverted yield, means that a 30-year fixed rate price is lower than an adjustable rate mortgage. And for the past 12 plus years, that's where we've been. A 30-year fixed, lower interest rate than an ARM. Why would you ever lock in an adjustable rate mortgage if you can get a 30-year fixed at a lower rate? You wouldn't ever.
Right.
That inverted yield is starting, the tide is starting to turn. And the reason for that is that obviously this year the Feds have been rather aggressive with their rate hikes. So we're starting to see that movement so that the adjustables are pricing lower. Now, I think that we're going to see a bigger margin there between a ARM and a fixed, where there's more benefits for the ARM. Right now, I would say maybe a half a point. You'll find that the ARM is better than a fixed, maybe 3/4 of a percentage point. Ideally, you want them to be a half, 3/4 a point, maybe more lower than a 30-year fixed. But that's where we're heading. So that's why 30-year fixed have been the only loan to consider for the last 12 plus years. So I want to just give you guys the statistical data. All right. There's a lot of emotion that goes into interest rate, and there's bad information out there, and we kind of get fixated on the sound bites, right, in the media and what they're saying. But the reality is, if you take a 30-year fixed mortgage and you were to get a statistic that says how many people start with that 30-year fixed and make 360 payments later, right? They start here and they pay it off in 30 years. It's less than 1%. It's probably less than 0.5%, the percentage of people that actually do that. Very, 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 very rare. Now, the shelf life of a 30-year fixed mortgage for a primary residence where you're going to live is about 7 years. So we know that an investment property is probably 2-ish years younger than that. So the average shelf life for an investment property loan is about 5 years. So knowing that, if we can get the lower rate on the ARM, which is what we're seeing now, there really isn't an incentive to take that higher 30-year fixed rate when we know that at the end of 5 years or 2 years or 3 years, whatever it may be, that you're going to be refinancing, one, to maybe pull cash out, harvest equity. Rates are going to be lower, right? When rates go up, do they stay up?
Not usually.
When they go down, they don't stay down either, unfortunately.
Yeah.
So we know that we're on the high, right? And I think they're going to continue to go up a little bit more over the next couple of months. I think it's going to be a much more modest pace in which they go up. But I think we're going to see a little bit higher in the interest rate category, but they're going to come back down. As sure as death and taxes, rates are going to come back down. So the overwhelming majority says that in the next 2 to 3 years, there's going to be another refinance boom. So keep that in mind. So if we know that 5, 6 years, whatever it's going to be, we're going to be refinancing that loan. That's the first thing. The second thing, a lot of people, I'm a fan of the interest only loan too, in addition to an ARM for these reasons. The interest only side of this, I think, is beneficial because especially right now with higher interest rates and some of the loss of cash flow, I think we're able to take advantage of the lower payment that interest only affords us, get a little bit more cash flow back. And all the while, if you look at an amortization table, you're going to notice that the first 10 years of any 30-year fixed mortgage, 98, 99% of your payment is going towards the interest, right? You don't even start paying principal until the back end of that loan. So for those reasons, I really think that investors should be doing the math, right? That's the first and foremost. But ARMs have a place, and they will continue to be more mainstream than they've been for the last 10 plus years for reasons I've described.
Yeah. I mean, like I said, we're kind of all agreement here at RealWealth. We think that this is the strategy that people should probably be employing. Is there any downside? Are the fees higher with adjustable rate or interest only? No, they're pretty comparable.
Yep. There's no fee difference. The only thing I would tell them is that if they are absolutely positive they're going to keep that loan for longer than 5 or 7 or whatever the ARM that they're considering, fine, take your 30-year fixed, but what are you giving up versus what are you gaining? And chances are you will be refinancing.
Yeah, I suppose I could see the argument for someone who maybe knew they were going to have a change in employment or they were going to retire or something where it would be more difficult for them to qualify for a loan, in the 5-year, 10-year horizon, that then maybe they would choose to, suck up the lower cash flow for the first couple of years, get it on a nice 30-year fixed. But if you're someone who, knows with reasonable certainty you'll be able to get a loan in the future, which you would probably say there's always a loan you can get in the
I
future.
was going to say that. I'm glad you did. Yeah, there's always a loan.
Okay, so how do we convince people that this is not the ARM loans of the past? Everybody just has PTSD, I feel like, from what happened before. How were those ARMs different back then?
Well, you know, when we look back and we look at those neg-am loans, or the no income, no asset loans, or the 115% LTV loans, those bad boy loans, and I think that ties into, that's a good point. I think that ties into people's emotional connection to this, or the mentality that they have about ARMs. They think just a standard adjustable rate mortgage is the devil because of those sound bites, right? They don't realize that there's a vast difference between a straight adjustable rate mortgage and the ones I just described, where investors were getting 100% LTV, no down payment whatsoever, no income documentation, no asset documentation. There were things called neg-am loans where you could actually pay a lower payment than principal or interest, right? If we didn't do any of those. But I think that's why ARMs were lumped into that, because most of those are adjustable rate mortgages, but they have different components, hybrid features to it. So I would say that in terms of education, guys, just do the math, right? The math will never lie to you. So if you look at a 30-year fixed against a 5-year ARM, let's just use 5 years as our example. What is the monthly payment difference? Whether it's principal and interest to principal and interest, or principal and interest to interest only, what is that monthly difference? And then you should be able to tell pretty clearly what your options are and which makes the most sense.
Okay. Do you have a percentage that you like to see generally, difference between the two that would make one more compelling over the other?
I would say 0.5 point is where I want the ARM to be in benefit, or
Okay, the interest
reduction to the fixed. Yeah.
Meaning you want the interest rate of the ARM product to be 0.5% lower than what the 30-year rate would be. Okay.
Yeah, to consider. If it's less than that, you know, and well, it's largely dependent too on the loan size, right? I think we've talked about this before. On a smaller loan size, 0.25 percentage point, let's say that the ARM is 6.5 and the fixed is 6.75 on 100 grand, take the fixed.
Yeah.
It's $12, right? It's inconsequential. I would take the fixed in that example.
Right. But I was looking at some performers the other day, and the difference of the ARM loan saved you, 89, or I think it was close to right around $90 a month. And it was a cheap house too. So like the cash flow, it increased by over 50% to go with the ARM loan. And in that case, I'm like, it's kind of a no brainer. It took your return, I think, from 6.5% cash on cash return to a 9% cash on cash return simply by selecting this loan over the other.
And that's the math, right? They have to be doing the math. Don't make the assumption based on psychological or emotional assumptions.
Right. It's hard though. A lot of messages out there conflicting. And so it's good to hear it straight from you. Caeli, if somebody wants to get in contact with you to learn more about your services, about the loans you offer, or if they have questions about adjustable rate mortgages, how can they get in contact with you?
There's several ways. They can check us out on our website, ridgelendinggroup.com. They can call us toll free at 855-74-RIDGE. Email info@ridgelendinggroup.com. Any of those will get directly to us, and we'll be on standby.
All right. Good deal. Thanks for joining me.
You bet.
See ya.